Today we're going to be talking about cheap mortgage rates, and if you're on the hunt for cheap mortgage rates, 7 mistakes that you may be making right now. Thing is, some people just get overly focused on mortgage rates. It can get to the point where they become obsessed with finding the absolute lowest mortgage rate on the market. And hey, I get it. We all want to save money. We all want to get the best deal possible. It's all about keeping as much money in our pockets rather than in the pockets of the bank. So lower rate obviously means you're going to pay less interest with a lower rate. Now, there's a lot more to a mortgage than just rate, and that's what a lot of people miss. In fact, when they become so obsessed with just finding that lowest rate, they miss a lot of other things which could come back to bite them or cost them a lot more money than the few dollars they saved each month with the lower rate. So that's what we're going to talk about today. First mistake is jumping on that lowest rate as soon as you find it without just thinking it's the best, making that decision based on the rate alone. This can be a very expensive mistake. It's a mistake that can be very easily made because you're just looking at the rate, thinking that all rates are equal. Fortunately, people have somewhat commoditized mortgages. They look at them as commodities where they're all exactly the same, like milk or sugar, but they are actually very different, and there can be a very big difference from one product versus another. And some people will make decisions that I know are not the right decision for them. I know it's going to come back and bite them, or going to cost them more money in the long run, or it might be something that doesn't even suit their needs. And we see this all the time. I remember one case specifically. Someone told me that they saw a rate, or they were quoted a rate from one of the big banks, and they were going to move forward with that. It was lower than the rate that we were offering, which can happen, but it's not that common. We are very serious about offering the lowest rates on the market here at PMT, and we do everything we can do to bring you those. Now, they chose this one particular product. They shared the lender and that information. So I basically advised them on that product and why it wasn't the best product for them. Yes, it was a lower rate, but given their goals and given what their plans were moving forward, this was not a product that suited their needs. One, it had a bona fide sale clause, and it was a 5-year term. Bona fide sale clause is something that basically locks you into that lender. It essentially marries you to that lender for the full 5-year term. Now, if you sell your property, then you can get out of it, but that's the only way you can get out of it. So if rates drop within those 5 years and you want to move to that lower rate, you can't. You're stuck. Even if you pay a penalty, you cannot leave that lender unless you sell your home. And that's the problem with that bona fide sale clause. And at the time, rates were in a downward trend. It looked like they were coming down. Plus, they were only going to need that mortgage for about a year. And then they weren't sure if they were going to sell their home at that point, or if they were going to turn it into a rental and buy another property. So in this case, they could turn it into a rental. They could keep the current mortgage, and if they were to sell it, it wouldn't make any difference at all. But if at the time rates were expected to be lower, and this is one of those situations where it would have been in their best interest to keep that term lower, not go with the 5 years, maybe go with a shorter term, or maybe go with a variable rate product where the penalty is limited to 3 months interest. I'm going to be talking about all these things in a moment. So jumping on the absolute lowest rate you see can end up being an expensive mistake, and there's a number of other reasons as well, which we're going to talk about here also, which leads us to the next point, is ignoring the penalty math. Now, with variable rate mortgages, pretty much all variable rate mortgages come with a 3-month interest penalty if you were to break that mortgage contract before the end of the term. Now, that 3 months can be calculated by either the contract rate, which is the rate your initial payments are based on, or prime rate. Some lenders use prime rate, most use the contract rate, but with the higher prime rate, that would result in an inflated penalty. Now, usually that's not a reason to go against this lender, but it really depends on what your goals are in the future. If you're planning on selling the property and buying another one, then, and you're looking at doing that, let's say within the next year, then even if the rate is a little bit higher, you might want to go with a variable rate mortgage that has 3 months interest based on the contract rate and not on prime rate. Because even if the rate is a little bit higher, this still might save you more money in the long run, depending on when you actually break that mortgage contract. So we're always going to take the time to advise you as well. We'll ask you questions. We'll help you to determine the absolute lowest rate and best product for your particular situation. Now, where the penalty is more important is when we're looking at fixed rate mortgages. Variable rate mortgages, the penalty is predictable. Fixed rate mortgages, they are not. Because with fixed rate mortgages, the penalty is written as the higher of 3 months interest or the interest rate differential, or IRD. Now, virtually all lenders use that same wording, but how that IRD is calculated can vary substantially from one lender to another, and that's where people can get themselves into trouble here. There are fair penalty lenders and there are harsher penalty lenders, and it all comes down to how that IRD penalty is calculated. And the difference can be substantial. In fact, the difference in penalty between a fair penalty lender and a higher penalty lender can be as much as 900%. So that could mean the difference between a $5,000 penalty or a $45,000 penalty. Now, I'm not saying that there's going to be this much of a difference. It's actually quite rare to see that much. There are even some cases where I've seen even a higher penalty, even above 900% more. But in most cases, it's somewhere in between. In some cases, there's no difference at all, like in cases where it's just 3 months interest, which does happen. Now, this is really more of a concern when you're going with longer terms, such as 5-year fixed. With 3-year fixed, the risk is substantially minimized. You're locking it in for a much shorter period. This also increases the chances of, if you do need to break it, it increases the chances of you having to face only a 3 months interest penalty or slightly higher than that. Now, this largely lies to where the rates are at the time you break that mortgage contract. So let's say rates drop substantially. Let's say rates were to drop another 2%. It's not expected to happen, but hey, let's live in a fantasy world. Let's just say they are. And let's say you have a rate today of 3.99%. Well, rates drop down to 1.99. Again, that's not going to happen, but this is just for an example. Rates drop to 1.99. Now you're breaking your contract with the lender at 4.99. They have to relend that money out at 1.99, which represents a loss to that lender. The IRD penalty compensates them for that loss. So, and like I said, that's just the concept of it. The actual math is a lot more complex than that. I actually explain it in detail in my book with 3 different ways in which the IRD can be calculated and how that difference can be affected with each of those situations. But like I said, the penalty to break a fixed rate mortgage can be harsh. Now, the major banks are all notorious for having among the harshest penalties. There are also some credit unions and the odd monoline lender that has a harsher penalty formula for calculating that IRD. Most of the monolines, most of the non-bank lenders are considered fair penalty lenders. So this is why we always take the time to ask you about your needs, ask you about your goals when we're trying to determine the best mortgage product based on your specific situation. So penalty is something you have to keep in mind. Now, a lot of people say, well, we don't intend to break the mortgage. Of course. Nobody expects to break it, yet so many people do. There's a lot of things that we don't expect to happen. We don't expect to get divorced. We don't expect illness. We don't expect disability. We don't expect loss of employment or health issues. These are all things that can really come back and disrupt whatever we thought we were going to do at one point. 5 years can be a long time and a lot can happen over that period. The next mistake that people make is they wait before locking in a rate. Let's say you have a mortgage coming up for renewal in 120 days, or you have a purchase closing within 120 days, it's further out. You wait, you call around, get a few rates, do a Google search, find out what the lowest rates are that's available to you, and then they wait. They wait and watch, hoping for rates to come down. thinking that they're going to find a better deal somewhere else if they wait closer to their closing date. Now, this is something that it's a mistake, and a lot of people make this, and I see people coming back time and time again. We quote them a rate. We may even tell them that there's upward pressure on rates. We may tell them that this rate is only for a limited time only. It will be going up soon. And the only time we ever tell people that is if it is true or if we believe it to be true. Now, markets can always shift, and sometimes they can shift quickly. Even if rates are in a downward trend, it can easily reverse and turn into an upward trend. So that rate that you were quoted a month ago may not still be available if you come back to apply for it at a later date. It's available at that time that it was quoted. So things can always change. Now, if we get a rate locked in for you now, let's say you have a closing in November, you get a rate locked in now, that doesn't mean you're obligated to take that rate. If that lender drops their rate, we will always get that rate lowered for you. We can do that generally right up until a week before closing. Sometimes we can get in a little tighter than that. Or we can even move you to a different lender if another lender has a lower rate. And we're always monitoring the rates for our clients. We're serious about getting you the absolute lowest rate on a product that suits your needs. That's something that we're always monitoring for our clients. But get a rate locked in, that at least protects you. If the rates go higher and if you don't have something locked, then you're going to have no choice but to accept that higher rate. But if you get something locked in now, you now have an insurance policy in place. You are now guaranteed that the rate will not go higher than that, but it can still go lower. You can have the best of both worlds by getting something locked in now. Now, we'll of course advise you, there may be times when it does make sense to wait a little bit, but we'll usually want to get an application and document package in from you. So if things do start to change, if it does look like things are going to change quickly, we can then act fast without having to wait for you to complete the application, provide documents and all the things that we need to get your rate locked in for you. So that can be a big trap, is waiting for rates to fall further. Next is there's a lot of people who unconsciously pay a convenience tax without even thinking about it. Now, I call it the convenience tax, but really this is, let's say you have a mortgage coming up for renewal, your lender sends you out the renewal offers and you're like, yep, this looks good. I had a 5-year variable variable looks good. I'm gonna just sign this and send it back without even thinking about that. That's it, you're done. Super convenient, but it can be a very costly mistake. And sometimes banks will send out renewal offers with their posted rates, which are substantially higher. This can be extremely costly, yet some people will just blindly sign that and send it back, costing them thousands of dollars unnecessarily. And of course, banks love it when people do this. Is it any wonder why they have the tallest buildings in every city? Banks know how to make money. So you don't want to just sign your renewal offer. Always do some research. Find out if these offers are in fact solid, if they are in fact competitive. In some cases there are. In some cases I've seen banks and other mortgage lenders come through with extremely competitive offers at renewal. In which case, if that works out to be what's best for you, we'll be the first ones to advise you to renew with that lender. We're never going to try to sell you something that is not in your best interest. We're never going to try to move you to something else unless it makes complete sense for you. So we're always going to look at everything and we are going to advise you as if you're our own family. You want to at least check with us before signing your bank's renewal offer. Reach out to us at info@pmtmortgage.ca. We'll ask you a few questions to determine which product is the best for you and your needs to help you to make that right decision. We will then advise you on whether we can do better or whether if you should take your current lender's renewal offer. And we are advising people to do that all the time if they are competitive, but if not, we will let you know the absolute lowest rates available for your specific situation. Number 5 is failing to consider your goals. Again, some people become so overly obsessed with finding the absolute lowest rate on the market that they don't even think about what their plans are moving forward or if it even if the mortgage even suits their needs at all. And that's why we'll always ask our clients a bunch of questions before we even quote them rate. We'll ask them questions like, how long do you think the home will suit your needs? If you plan on expanding your family, or if you might expect a change in your relationship status. If you're planning any renovations, we'll ask you, what's more important to you, a lower rate or a lower payment? And that's a question that confuses a lot of people, because people think, well, lower rate means a lower payment, right? This doesn't make any sense. But no, that's not always true. If the amortization is the same, yes. But why we're asking that question is because we want to know what your priority is. If you do prioritize a lower payment, let's say you're coming off a 1% range interest rate that you got in 2021, well, now you're going to be renewing at much higher rates. So you're going to have a large jump in payment, which a lot of people don't feel comfortable with. So we can look at refinancing to increase your amortization. This will result in a little bit of a higher rate, but it will bring your payment down substantially, possibly in line to what you were paying before, or maybe even a little bit lower. So we'll talk about that. It just really comes down to what your personal goals are and what your personal preference is. You also want to ask yourself, okay, what are your plans with this property? How long are you going to stay in this home? Or do you plan on maybe purchasing an investment property down the road? If you're looking at purchasing an investment property, then we might want to look at refinancing you to a 30-year amortization. Even if the rate is a bit higher, it will bring your payment down, which will then allow you to qualify for a larger mortgage on the investment property that you're planning on buying in the future. Or even if you're planning on turning the current property into investment and buying a new primary residence for yourself, that's a very common situation too. As that's your plan, we may want to look at refinancing it to a 30-year amortization, bring your payment down. That way you're going to qualify for a larger mortgage when you go to purchase that new property, because the current property is going to factor into your debt to income ratios. It doesn't matter if the rental income covers the mortgage or not. That's not how it works. A lot of lenders will only look at 50% of that rental income. So even if it carries itself, even if it's cash flow positive, the lender may not see it that way. And it may be the difference between qualifying for your dream home versus qualifying for a home that's just okay, or qualifying for a home that you might not be happy with at all. So that's why we ask these questions. That's why you have to understand what your needs are before making this decision. Another thing we'll ask is if you need to add a HELOC, if you want to add a home equity line of credit, if you have renovations coming up, well, maybe we'll want to give you something with a HELOC. Maybe you want to take out some additional funds depending on when you plan on doing those renos, or add a HELOC so you've got money at your fingertips for when you need it, so you can fund your renovations. Another thing also is many people have a goal of paying their mortgage off faster. And prepayment privileges are something that virtually every lender has. This is what allows you to prepay an additional amount towards your mortgage during the term without penalty. Now, the prepayment allowances can vary from one lender to another, and this is very important because there's some lenders who have quite limited prepayment privileges. Let's look at RBC, for example. RBC has a lump sum privilege of only 10% per year. Most lenders are 20%. Now, that alone is fine. It's going to suit the needs of most people. If you have a $500,000 mortgage, that still allows you to pay $50,000 towards your mortgage per year over and above the scheduled payments. You can even double up your payments on top of that. So from that standpoint, it sounds good. But the problem is that RBC limits you to a single lump sum payment per year. So let's say even if you're allowed $50,000 in annual lump sum payments, as soon as you make one $5,000 lump sum payment, you cannot make another until the next anniversary year. So if you plan on aggressively paying off your mortgage, RBC is probably not going to be the best lender for you. We would look at finding one that has more aggressive prepayment privileges. Most of them will allow you to make as many lump sum payments as you like, providing that they fall on a scheduled payment date. Or a lender might say, well, it doesn't have to fall on a scheduled payment date. No, you can make it at any time, but it will get applied to your mortgage on the next scheduled payment date. And that's how that works. So a lender that has the flexibility to make multiple prepayments, multiple lump sum prepayments throughout the year, can save you far beyond what you would save from a slightly lower rate if that is your plan, if that's your goal. So very important that you know your goals before you choose which option you're going to go ahead with. Number 6, second last, believing all rates are equal. Now there's many differences between mortgages, as I mentioned. Not all rates are equal. Rate is just one component of them. One thing that you want to look at is if, let's say you're looking at a variable rate mortgage. Variable rate mortgages can have different ways that the lender compounds their interest. Now, fixed rate mortgages are always compounded semi-annually. Doesn't matter which the lender is. Any lender in Canada is going to compound the interest on your mortgage semi-annually. Any prime lender, semi-annual interest compounding on fixed rates. But with a variable rate mortgage, it can be compounded either monthly or semi-annually. Now, that can make a difference in the overall cost of the mortgage, and you won't even know, you won't even think about it. You'll be like, oh, this is the rate, I'm gonna go for that. And it might be compounded monthly, and you might think you're getting a better deal than what you actually are. So let's say, for example, we have a $500,000 mortgage amortized over 25 years at 3.45%, prime minus 1%, which is available for some situations. And you have two options at that rate. One is interest compounded monthly, the other semi-annually. So with the monthly compounded option, your monthly payment on that is going to be $2,489.74. With the semi-annual compounded option, it's going to be $2,483.18. Now it's a difference of $6.56 per month. Not a huge difference, but it still is a difference, and it's still worth noting. It's equal to about 0.025% in interest rate. So that's about the difference that it is. That helps you to get a better idea of what the rate difference works out to based on that compounding difference. Now that's where rates are today. As soon as rate starts to increase, that rate difference increases. It's 0.0253 right now, but as rate increases, the difference will always increase too. If rates were to go up to 5%, then we're looking at a difference of around 0.05% based on compounding alone. So you might think you're getting a better deal than what you actually are based on how that mortgage is compounded. Usually if there's 0.1% difference, then compounding is not a reason to choose one option over another, but it's when the mortgages are close. When the rates are close or the same, that's when compounding is a major consideration that you need to make. Number 7, the final one, is choosing the wrong mortgage professional. Now, a lot of people, they shop around for rate, they go with the person who has the lowest rate, but there's a big difference between one person handling your mortgage versus another. Unfortunately, in this industry, there's a lot of people who are in the role of mortgage advisor that are really not much more than order takers. They're really not mortgage experts. They'll take down an application. They may try to answer your questions. They may be able to answer some basic questions, but a lot of them may not really know how to properly advise you. And that's why experience can be huge. You always want to make sure you ask a lot of questions. You don't want to trust your mortgage to just anybody. There's a huge difference in the service level. There can be a huge difference in your overall experience. Like, let's say you have a purchase coming up for closing and it's closing in 2 weeks and you don't know where your mortgage stands because your mortgage advisor has not been in touch with you and has not returned your emails. Now it's a week before closing, you still don't know what's happening. This can be a problem. This can create a huge amount of anxiety unnecessarily. Or maybe the person goes on vacation and doesn't tell you. Like, these are all things that can happen. Unfortunately, there's a lot of people in this industry that look at it as a job and not really as their career. They really don't seem to care, and it can come through in the quality of your experience. So it's really important to ask a lot of questions. Search their profile on LinkedIn, find out how long they've been in the industry for. For all you know, they've only been in this role for a week or two and they're advising you on your mortgage. So you want to ask these questions, build confidence. If they have to get back to you with the answer on any question that you have, even simple questions, then they're probably just more of an order taker and not really a true mortgage professional. You have so much money riding on your mortgage. You don't want to trust it to just everybody. We are very serious about the quality of advice that we provide here at PMT. I don't hire just anybody. It's not easy to get on this team. Anybody on the PMT team is going to be solid. They're going to be vetted for me. I only hire people with post-secondary education, good people who are sharp, who know what they're doing, and who will advise you based on your best interest. They have to align, of course, with my core values, with the PMT core values, to ensure everybody is getting the best experience possible. And that's one thing that sets PMT apart from other brokerages, is that we have a consistent experience. If you go to other brokerages with independent agents, you don't know what you're going to get. Everybody's got a different experience. Everybody's using different lenders, different processes, different systems. With PMT, it's going to be the same every time, regardless of who you're talking with. And everybody works directly under me, so I'm still your broker, but I rely heavily on my team to advise as many people as possible. That way we can help out as many people as possible. Another thing that makes us different, we have a brick and mortar office where we all work in the office together. Usually Monday through Wednesday, we are all in the office together. Then Thursday and Friday are our work from home days, or in my case on Thursday, work from the boat, which is a great spot to work. That's about everything. So again, you definitely want to make sure you do some research on the person you hire to handle your mortgage for you. Doesn't matter if they work for a bank. Banks tend to look at the role of mortgage advisor as somewhat of an entry-level position. Who's going to get the best people? Now, don't get me wrong. There are some really quality people that work for the banks, just as there are some really quality mortgage brokers out there. There's also a lot of really bad ones. This industry has a very low barrier to entry. So you're going to get your share of people who just don't care or don't know what they're doing. They look at it as just another role. They don't have that same dedication. They don't put their client's best interest first. They may advise you based on what they're incentivized by their employer to sell. So they may try to push you to take something, even if it is not in your best interest. So if it seems like they're pushing you to something that doesn't seem like it's for you, you have to ask yourself why. And unfortunately, there is a ridiculous number of people in this industry that advise based on what's best for them. At PMT, we look at building clients for life. We want to have a lifelong relationship as your mortgage advisor. So we are always going to be advising you based on your best interests. And we realize we may not get your business every time. If another option makes more sense and it's the right choice for you, we will be the first ones to advise you to take it. With us, this is not just a job for us, it's our career. And in fact, it is so much more than that. We are passionate about advising people on mortgages. It's what we love to do, and this passion will not go unnoticed by you. It's one of the reasons why we have more than 850 five-star reviews on Google, and we'd love to add you to that. So if you have a mortgage coming up for renewal within the next 120 days or a purchase closing within 120 days, reach out to us at info@pmtmortgage.ca. That's short for Paul Meredith Team. Or you can call us the old-fashioned way, 647-368-5009. You can also text us at that number, and we will find the absolute lowest rate for a mortgage product that is going to be best suited to your needs, not just now, but in the future. It's one thing to get the lowest rate right now, but that can be short-term thinking. We want to think ahead and make sure we're setting you up for future success with your mortgage so you can keep as much money in your pocket at the end of the day and not in the bank's.